let's take a look at a couple of examples to reiterate this concept. At this stage, once again, I would like to remind you, we are talking about the accounting for lessees. We will come to what the lessor also needs to do. Okay. Let's read this example for a minute. And there is one important point that would be relevant from a practical perspective, which I will highlight as we go about the discussion. Here is an example of a lessee entering into a lease to lease one floor in an office building for 10 years. The business has expanded. At the beginning of 7 years, the lessor and lessee amend the contract and said, why don't you use one more floor for the balance period of time? Now, what is important is that the lessee says, look, you don't have to go about hunting for a lessor. You don't have to do a background check for what the lessee is going to be. You will save costs on doing an assessment of whether the lessee is genuine, will pay rents on time. Please give me a 5% discount. Now, what the standard would require us to assess is effectively what is the impact of this 5% of discount on considering the condition that the standalone selling price or the standalone lease rental of the new floor is also at an independent or an arm's length price. So would this be accounted as a separate lease? The assessment is yes, this would be accounted as a separate lease for two reasons. The first one is this is clearly an increase in scope. And we said there are two conditions. The first is that there should be a scope increase. Having concluded that there is a scope increase, the next assessment that I would need to do is whether the additional rental that is to be paid is commensurate with market rentals for a similar space. In this case, although the rentals are lower by 5%, the conclusion would not change for the reasons that this is effectively an impact or a benefit that the lessor gets by not having to incur other costs. If one had to lease this property out to a third party or an unknown party, the lessor may even have had to pay a brokerage or a fee. This 5% discount is a reflection of that piece of the transaction which the lessor would have otherwise had to incur. And one would therefore conclude in this case that the lease rentals are commensurate with what a similar property would have fetched. And that therefore means that the additional floor gets recognized as a separate lease. So you will separately find out what are the future cash flows of this lease obligation, present value them using the incremental borrowing rate at the beginning of year 7, and then work out the ROU and amortize the lease liability. Let's now look at another example of a modification. And this is where we will cover the other two scenarios. Remember, at this stage, we are still talking about the lessees. For the lessors on the group, we will come back to what the lessor accounting also is. Lessee Z enters into a lease contract with lessor L to lease certain amount of space in an office building for 10 years at a discount, at a lease rental of 1 lakh per annum. The incremental borrowing rate on that date is 7%. If one had to discount 1 lakh rupees for 10 years at the date of inception, the present value of that on day one would have been 7,02,000 rupees. There are a few questions in the chat box. We'll try and answer them in parallel, or otherwise we will surely come back to you at the end of the discussion. So coming back to our example, let's just focus on this example. On day one, present value the 1 lakh rupees payable for 10 years, discount them at 7%, which is the incremental borrowing rate. So on day one, the lessor has, or the lessee has a right of use asset of 7,02,000 rupees and at the same time recognizes a lease liability of 7,02,000 rupees. At the beginning of year 7, the lessee sees that the business volumes have reduced and wants to give up 25% of the space. Additionally, the lessee also says, please reduce my rentals by 25% and let it be reflective of the current market scenario. The lessor and lessee agree. At the beginning of the 7th year, the discount rate on the lease has now moved to 8%. The accounting treatment that the lessee would have followed is they would have, on the 7,02,000 rupees of ROU, amortized that for 6 years and taken that amortization as a charge through P&L. So one would see a lower balance of the ROU at the beginning of the year, which works out to 2,80,000 in this case. And on the lease liability, they would have recognized interest expense at 7% on 7 lakh in year 1, adjusted the 1 lakh payment, and accordingly would have arrived at a lease liability outstanding of 3,38,000. Friends, this example covers 2 scenarios. It covers the scenario of derecognition or a reduction in the scope, and it also covers a scenario of a reduction in the consideration after a part of the asset is given up. The standard states don't treat them as a separate lease because the scope is reducing. However, there is a distinction to be made in the sense that on the portion of the assets that is given up, which is the 25% floor space, a gain or loss on the derecognition of the ROU and lease liability would be recognized in the P&L. Thereafter, one would give impact to the reduction in the consideration. Let's look at what exactly would have happened in terms of the numbers. As we said, it's a 2-step process. Step 1, determine the carrying values of the ROU asset and liability before the modification. Now, after the modification is done, effectively the lessor and the lessee said that only 75% of the asset will be within the scope of the agreement. So if one had to take 75% of the ROU should be reflected in the books at 2,10,000. Similarly, the liability would also correspondingly become 75% of the liability before the modification. So 75% of 3,38,000 is 2,54,000. The accounting entry in this case would have been to debit the liability by 2,54,000, debit the liability by 84,000, credit the asset by 70,000. This would have resulted into a gain on modification, which is recognized in the P&L. So as part of this entire plan that we have seen so far, 2 things have happened. The first thing that happened is we have accounted for the scope decrease. We have said a part of the asset is given up. If an asset is given up, you recognize a gain or loss on the modification. And that, in our example, is a gain of 14,000. Now the position that I have reached is I have now reflected an ROU asset and a lease liability by discounting 1 lakh rupees for 75% of the space at 7%, which was the rate on day 1. However, the standard or the counterparties have agreed, let's reduce the rent to 75,000 instead of 1 lakh per unit. This is an example where my consideration has reduced. And we said that in case a consideration reduces, you will need to present value the future lease rentals or the new lease rentals that are agreed using today's discount rate. As a lessee, therefore, I would have calculated the present value of 75,000, which is a reduced rental, and discounted it by 8%, the incremental borrowing rate on the date of the modification. As we can see, that would have given us a present value of 2,48,000. The financial statements, however, reflected a carrying value of 2,54,000. So the way to bridge this gap of 5,600 is by crediting the lease liability by 5,600 and debiting the right of use asset by 5,600 rupees. A change in the consideration is P&L neutral because it impacts the ROU only on the date of the modification. Of course, it will come through the P&L in the future by way of amortization of the ROU, but on the date of the modification, it is P&L neutral compared to an example where the scope itself is reduced. Because if the scope is reduced, one would need to take a gain or a loss on the modification to P&L. This, friends, summarizes the accounting for modifications for a lessee. These are situations one would exactly expect to see in the current COVID environment. The economic impacts are felt by everyone. Lessees may want to negotiate either by giving up space or by reducing the rentals or by seeking deferrals, seeking waivers. All of these are examples of modification accounting. And in most cases, if the modification was in terms of the consideration and not the scope of the asset, one would have to therefore estimate what the new revised cash flows are, discount them at today's incremental borrowing rate, and adjust the ROU. So cumbersome exercise in a practical sense, and that is where there is an entire expedient that has been brought about.